How do I have profit but no cash? This is a really common question that I get, and it's oftentimes uh, happens around tax time when a business owner, maybe they haven't looked at their finances throughout the year. You go, you sit down with your CPA, they've just completed your tax filing, and they say, hey, you made a profit of $75,000 and that's what you're going to pay taxes on, or 250,000, whatever your profit is. You have to pay taxes on this amount. And every single time you see that amount, and regardless what it is, it always feels higher than it should be. You look at it, it's like, how did I make that much profit? Like, I felt tight for cash this entire year, and you're telling me that I had $300,000 in profit? That doesn't make any sense. So I want to just break down just kind of some of the uniqueness of accounting and what the profit that you see, your taxable profit is, and how that relates to cash and what the differences are. So I'm going to just use a really basic example. These numbers are not for any specific industry. I'm just using random numbers to show and prove a point. So let's just say that this business is an LLC using cash basis accounting. I won't go into the details of what that means, but let's just use that as our framework. So let's just say quarter one occurs, and here's the results. You have sales or revenue of $100,000. You have cost of goods sold or cost of services sold of $25,000. So it costs you $25,000 in direct costs to provide those services. Or your profit margin is $75,000. Your overhead or all of your expenses, insurance, payroll, all of those, $50,000 for the quarter. So you're left with a net income or net profit of $25,000. So when you go sit with your CPA or your tax filer, this is the profit that they're looking at. They're saying this is what you're taxed on. This is your taxable income from the business, $25,000. And you say, well, that's all well and good, but I don't know where that $25,000 went. Well, here's the difference between net income and the actual cash that goes into your bank. So you have $25,000 in profit. So this would be operating profit, however you want to. There's a lot of different names that accountants use, but you had $25,000 in profit for the quarter. And you had, let's say during that same period, you wanted to upgrade some of your office equipment. So you bought a really high-end piece of equipment or computer for $3,000. So you spent $3,000 on equipment. You also have loans. Maybe it's a vehicle loan for the business. Maybe it's you own the property that your business is in, and so you pay a mortgage on that every single month. We're going to call your loan payments for the quarter of $10,000. And then you're an LLC, so you don't have any payroll because you're not an S corp or a C corp. So you're just taking money straight out of the business. So let's say you take $15,000 out or $5,000 per month. This is your owner's pay. So you're left with negative $3,000 because $25,000 minus $28,000 is negative $3,000. So what does this mean? Well, $25,000 profit is your operating profit, or how much money the business produced from operations. And from an accounting perspective and a tax perspective, the IRS looks at certain transactions differently. If you make a purchase of some type of item, equipment or a vehicle, generally the threshold is $2,500. If you make a purchase over $2,500, it's not included in your expenses. Like, it's not considered an expense from the IRS perspective. It's considered an asset. And so assets show up on your balance sheet. They don't show up over here. They don't reduce your net income because the IRS says, hey, this is something that you purchased and own. And so what shows up over here is actually depreciation. The purchase of the equipment does not reduce your net profit unless it is being depreciated. Okay, that's a lot of jargon to say you spent cash, but you're not going to see that drop your net income, not on a P&L right away. Same thing for a loan. So at some point you took out a massive loan for something, you took out a big loan, maybe it was $100,000, maybe it was $80,000, maybe it was $500,000. Whatever your business is, you took out some type of a loan over the quarter, you're paying $10,000 over that quarter. Now, when you're making a loan repayment, the cash that you spend to repay that loan is not considered an expense. The only part of this that is an expense is the interest. So if you're keeping good books, maybe you're splitting this out quarterly, monthly, annually, the interest will show up over here. But whatever you're paying towards the principal of that loan is not considered an expense. You're still using cash, but it's not an expense. It's on the balance sheet. Same with owner's pay. If you're taking money out of the business for owner's pay, or you're, doing a no-no, which I would say to completely avoid, and you're putting personal expenses on the business card, and they're getting categorized as owner pay or owner draw or distribution, depending on your structure. We're an LLC, so we're going to say it's owner's draw. And that's not going to show up as an expense. You're still using cash, but it's not an expense. It shows up on the balance sheet. It's lowering what we would call as your owner's equity. So what does this all mean? Well, you had a net profit of $25,000, but that doesn't mean that you had a cash increase of $25,000. It means that while operating your business from an accounting perspective or a tax perspective, your business created profit of $25,000. Okay, you created profit. But there's additional transactions that used cash, but were not directly related to operations. So you took out a loan. That's not, repaying a loan isn't part of operations. That's repaying a debt obligation. Purchasing equipment, you might be like, well, that is part of, operations. I need the equipment for the business. But from a tax perspective, there's unique guidelines. There's guidelines that dictate when you can consider something an expense and when you have to consider something an asset that gets expensed over a matter of time. Owner draws, again, same situation. You used cash, but it's not considered an expense in an LLC because this is just flow through. You're getting taxed on the $25,000. It doesn't matter what this $15,000 is. So what am I trying to get at? Okay, so you had $25,000 in operating profit, but you had additional cash usage of $28,000. So in a period where you had profit of $25,000, you still lost $3,000 in cash. Does that make sense? So because you had a profit, you spent $3,000 on equipment that the IRS isn't considering to be an expense right away. You spent $10,000 to repay loan principal. The IRS doesn't consider that an expense, but you still use the cash. And then you used $15,000 to pay yourself. So in that first quarter, you actually lost $3,000 in cash. So if you started with $30,000 in cash at the beginning of the quarter, at the end of the quarter, you have $27,000 in cash, and you're being told that you had $25,000 in profit, and these things don't compute. I made $25,000 in profit, but I have less cash than I started with. How does that make sense? Well, this is how it makes sense, because not every transaction, not every use of money that occurs within your business is affecting your P&L. So you could lose cash all year long because you have way too much debt. Or you could lose cash all year long because you're taking way too much out for your own personal use. And you're still going to be taxed on $25,000, even though you lost cash. Okay? This one kind of plays out. If you're buying equipment, this one you can usually depreciate. And so this will help your taxes in the long run. But over a quarter, you're not going to see those depreciation unless they're being entered monthly. Generally, a lot of times accountants don't enter that till the end of the year. Or there's all different rules that dictate to depreciation that we won't go into here. But these two specifically can drain cash and still leave you with a tax bill. Okay? So let's say you eliminate this and you have $10,000 in a loan interest. So we're just going to remove this all together. You have $10,000 in loan let's grab this. So you have $10,000 in loan payments and $15,000 in owner draw. So you have $0 in cash every single month, or at least for this quarter. You got $0 in cash for the quarter. But you still have to pay taxes on $25,000, okay? So if you're at, a 40% tax rate, you're going to be paying, obviously this is super high, but let's just say you have to pay on $25,000, you're over here and you're going to have to pay $5,000 in taxes after all of your tax credits and everything else. Well, you made $0, so now after taxes, you're at negative $5,000. Do you see how this all works? So if you don't understand your business, you don't understand your money, you don't understand your finances, you might get told every single year that you have some crazy level of net income. You might, I've seen clients that have $130,000 in net income, but they took out $120,000 in personal owner draws. And so at the end of the year, they're paying taxes, which depending on your structure could be, $20,000, $30,000. However, they haven't set any money aside because from their perspective, the business hasn't been that profitable. But from the IRS perspective, you've got a lot right here to be taxed on, even though you had $0 in cash. Okay? So how do I summarize all of this? What's one thing that you could take away from this? Let me clean up my page here. So how do I have profit but no cash? Profit does not equal cash in the bank. Profit instead is a measure of efficiency within the business. They want to know how efficient your business is. They want to know how efficient the business operates, how well it turns revenue dollars into profit dollars. Okay? But this is generally for taxes and loans, etc. But profit does not equal cash. So there's a different measure for that, and that is called cash flow. I'm sure you've heard this, but that is what cash flow is. Cash flow measures the increase or decrease of cash over a period. Profit measures the efficiency of the business. So this would be your P&L. So your profit and loss statement measures the efficiency of the business in turning revenue into profit. Your cash flow measures the efficiency of turning profit into cash. So the reason that you go sit down with your accountant and you hear a profit number and it doesn't make sense and it doesn't equal what you have in the bank is because there's other transactions that you do on a monthly, daily, weekly basis where you spend money, but it's not considered a business expense. It's not showing up on your P&L. It's showing up on your cash flow statement and it's showing up on your balance sheet. Okay? And we'll get into like what the balance sheet is, what the balance sheet means, what it actually measures in a later video. I won't go into that here. But I wanted to explain and try to give an overview of why the profit doesn't make sense to you, what's causing the variance, and help you understand how the money actually flows and how the IRS looks at things. I hope this makes sense. If it doesn't make sense, please let me know in the comments that this doesn't make sense. If it does and you loved it, let me know that as well, so I can continue to curate how I present this information to you guys.